Welcome to Venture Step Podcast, where we discuss entrepreneurship, industry trends, and the occasional book review. Today, we are going to be discussing California. California, as you know, has been burning and has been burning for some time. A lot of the fires are not controlled. The most notable fires are Palisades and the Eastern Fire. The Eastern Fire, I think, has 0% containment, and the Palisades has 6% containment. Over the course of the last couple of weeks and years, there's been quite a bit of discourse on who is to blame with these California fires and the mismanagement of insurance in general. Is it the insurance companies? Is it the political party or the government mismanagement? Or is it a multitude of things? Well, I'm pretty sure it's a multitude of things. And we do have a guest on the show, Tom Mercer. Tom Mercer was a previous supervisor. He was my boss, and he has since moved on and starting a new program. But the reason why I might be so smart in commercial insurance is because Tom has nurtured me over the last couple of years, and I'd known him previously at a different company, and he'd always been very intelligent and thoughtful with the words and ideas he distributed to others. So really excited to have him on the show. In his free time, he likes to boat, right? He's a big boater and just likes to have a good time. Mountain biking,
Mountain bike,
sailing. And didn't you grow up in California or spent substantial amount of time in California, correct?
I have, yeah. I was in the Navy there in San Diego, and then I went to business school at UCLA, so very near to where the current fires are. I've hiked in those hills that got burned up when I was at UCLA, and then was working in West Los Angeles for a while. So.
Nice. That being said, we're glad that Tom is on the show, but this is not financial advice or legal advice. If you're looking for that, speak to a licensed professional in your respective state. Okay, so we'll just jump right into it. The topics today we're going to be discussing is California, the wildfire, the state of the market, and just in general, how does that influence commercial insurance or insurance in general? How does this all intertwine with insurance, like with the fires? What went on? How did things fall apart over the last coming years, maybe the last 7 years, 10 years? Because it's not just one day things fall apart. It's a slowly deteriorating foundation of what's been going on and what you're seeing and what's coming to light now. And then we'll be discussing just in general some lag and regulation changes that need to be done with California for it to be a little bit more competitive. And then the last thing we'll talk about is commercial lines in general or commercial insurance. What are some key problems that need to be solved by technology? And that will allow me to bring in some guests on the show related to those areas that will provide interesting information. But the first topic that we'll be talking about is the California wildfires. So I'll just start off real quick and kind of level set. The Eastern fires and the Palisade fires, both of which I mentioned earlier, don't have that much containment at the moment. Why are the fires not contained? Well, when a wildfire starts and the wind is over 40 miles an hour, there is nothing that can stop the wind. The wildfire is, in general, wild and can't be tamed until the wind dies down. So the firefighters need to be on standby and wait for the wind to die down, and then they can attack the fire. But as soon as those winds get to those dangerous levels where you can't predict where the fire will go, and the fire is burning at a rate that isn't controllable or sustainable for the firefighters to be nearby, they have to pull out and come back when the winds are died down again. But the issue is now, the last couple weeks, there's been some sustained gusts over 100 miles an hour. So it's 3x potentially of what we could, almost 3x, not quite, but definitely 2. Yeah, no, 3. Yeah. 40 times. Yeah, that makes sense. Once again, this is live. Anyway, so 3x of what would normally be considered dangerous. So just to put that in perspective, that's why the fires can't be controlled. And the current damage done so far is about 5,000 buildings in the Easton fire and then 5,000 buildings in the Palisades fire. And then with general math, the median building value for the Easton, I think, is 350,000. And that came out to, a couple billion. And then the Palisades fire was a median household value of 3.5, but most of those houses are on the FAIR plan. I assume that they all were. And the max coverage for the FAIR plan is $3 million for residential buildings. That being said, the risk for both all in is about $25 billion in losses potentially if they were all total losses. Tom, do you want to include anything that I missed there? Hey, jumping in here mid-episode to let you know that this recording was done 2 weeks ago and we're just publishing it today. That being said, some of the information discussed is dated related to the fires. The fires are more contained than they were when we spoke about them in the episode. The Eaton fire is 98% contained, burned just over 14,000 acres. The Pacific Palisades fire is 94% contained and burned just over 23,000 acres. Overall, wonderful episode. Appreciate Tom coming on the show. Hope you enjoy. I'll let you go. Just wanted to point that out. I'll let you get back to it. See ya. Bye.
No, I think you covered it. We can spend some more time about the FAIR plan and what that means. That's a state market of last resort, and that's grown in wildfire exposed areas. And we'll touch why that has happened, and because of really what's been going on with the private market and the regulation challenges that exist in the state. Yeah, I don't have the latest estimates on the fire. And I'm not certainly not a fire expert, but as Dalton says, when the winds are blowing this strongly, it's very hard to contain. It's impossible to contain a fire, and a fire becomes extremely dangerous for firefighters to be around. They can just be quickly overtaken by the fire. There was a fire that occurred near my house when I lived in Colorado, and it was not too far from Boulder, Colorado, between Boulder and Denver, in an area called Aurora/Superior. And it's not really it wasn't an area that was particularly prone to fire. It was a suburban area, but again, like the fires we're seeing here, the winds were very, very strong, and it burned up a substantial share of this neighborhood, very, very quickly. So a combination of really any fire and high winds is truly deadly. As things burn, as houses burn, embers come off, and those embers can ignite. And what we had going on in the Palisades, and all of really Southern California, is they've had very light rains. My understanding since last spring, well below normal range, and so you had a very dry environment, coupled with the winds. And then as far as the source of ignition, that's remains to be determined. But there's all kinds of things that can be doing that. A person careless with a cigarette butt at a car, could conceivably cause this. A homeless person potentially cooking a meal somewhere, or what's happened before is the power lines can actually cause and spread fires as well. And so there's been people pointing at that, but at this point we don't really know the causes of these things. And I just think it's somewhat immaterial, unless it's truly an arson situation. There's just so many ways that these things can be caused, and under the right conditions of high winds and very dry conditions, they're gonna spread. So.
No, I think it's fair. One thing I'd like to point out, my math was wrong. I think I said 350,000. It's 3.5 million for Palisades and then 2.1 for Easton. And so that brings it around, $25 billion. But yeah, as Tom said, the main thing here is the winds are high. The winds also contribute to embers flying. Embers are one of the leading causes of a fire. A lot of times fires spread not home to home, but with multiple embers latching on to a home, and then that home burning over time with the winds hitting the ember and the ember causing fire to the home. Correct? Right? I think 70% or something like that. So definitely over 50% of the time, an ember is what's causing the fire. It's not a fire. Your home is directly impacted by the fire, and in your home catches fire because it's engulfed in fire and flame. That's typically not how it goes down.
Yeah. And the other interesting thing, my understanding is in both of these areas, there were still older homes that had wood shake roofs, and that's basically the most standard roof you see on most homes is a composite shingle roof. Uh, those have some fire resistance. They're not as strong as metal roofs, but these wood shake roofs are literally made of slabs of wood, and you can imagine in a place like California, those wood shake roofs will dry out, and so an ember lands on those, and can start a fire. And so those have been banned now over 50 years, but they've allowed grandfathering of existing structures, and as long as they keep those roofs repaired, so that's a problem, and it speaks broadly to a problem which we'll talk about later on, or maybe we'll talk about it as far as built. We're not really built today, other than some small measures. We're not really building buildings to be um, fire resistance from wildfire exposure. So
Yeah, I think that's a good place for us to move on. I think we provided some background on what's going on in California. The next thing is to talk about the regulation lag, or not only just the lag of regulation, but the over tightening of regulations within California related to wildfire risk. And in general, the sense is, like, one of the main things that we couldn't do as an insurer in a admitted market, there's two markets. There's admitted lines, which is a insurance company that is registered and accepted by the state, and they have to follow what the Department of Insurance does. So if the Department of Insurance has an exact rule, then the admitted insurance carrier needs to do that. There's a lot of requirements regarding rate changes. They need to be approved by the DOI. Form changes need to be approved by the DOI, and they need to be scheduled. There is another section of insurance called non-admitted, which is what has been serving California in a greater, more prominent stance than it normally would, because of the lack of supply in the admitted market, simply because there isn't the ability for these admitted companies to provide the right premium to the higher risk areas, thus making it, one, unprofitable, two, not very competitive, because you can't segment the risk. And that's the good thing about insurance, is that typically, if it's done correctly, everyone would pay their fair share, and you're getting charged what your actual risk is. But if you can't segment the risk, then you're charging everybody the risk, which is unfair to you. And if the admitted market can't do what the surplus lines market is doing, then they're not competitive in that regard.
yeah, if you want to expand on that a bit, Dalton.
Yeah. So one thing admitted lines can't do that a surplus lines carrier could do, or MGA, is that they can include their reinsurance costs. And this has been a recent change. As of early December, California did change the rules where you could include your reinsurance costs. But the caveat was it needs to be within what they deem to be industry standard. And the issue with that is reinsurance is very customized, very complex, and overall there is no standard. Everything is a customized contract, given your portfolio, what you want to do, the notional portfolio, which is your example portfolio that you send to the reinsurance market or you go to market with. And that's how you raise capital to get people to sign on to your program, and they think it's a good idea. But there is no industry standard of, okay, this is what you have and this is what the industry standard is. It's $2 per foot for this. Like, it's not a piece of wood. It's a very complex and complicated international contract that is not by any means standard. So that being said, go ahead. You want to take it on?
Yeah, let me elaborate on this a bit. So, and explain what when we say reinsurance, what that means. And so, what insurance companies will do is they buy protection for large events, and they go to these global capital providers for that. So, whether it's a major wildfire, whether it's a major hurricane, whether it's a tornado, at some point the losses for these large events are more than an individual insurance company wants to bear, and so they then buy protection for those larger losses from these global reinsurance companies, and these companies are covering these sorts of risk around the world, and Yeah, and that those costs have been rising, and they've been rising across all lines of coverage because because of the higher climate activity. So we've had an unprecedented number of Cat 4 hurricanes make landfall in the last, what I saw a statistic the other day. We've had more in the last 8 years than we had in the 41 years or 46 years prior to those 8 years in terms of Cat 4 or above landfalling hurricanes. We've had some pretty bad tornadoes as well. That Joplin is the most famous, but there's the massive hail events and tornado events that are costing it quite a bit. Because this is the global reinsurance market, there's events around the world, events in Japan, events in Asia, that are all drawing, and events in Europe, a big flood in Europe last year. All these events are drawing on this capital, which so as this capital has to pay out, they need to charge higher and higher rates to compensate for these losses. So an insurance company has to pay those, and those vary every year. That's a new contract every year. We've seen rates on reinsurance, going up 20, 30, 40% a year in recent years. But until just literally weeks ago, as Dalton said, um, insurers in the state of California could not pass on these costs to consumers. They couldn't include these costs in their rate filings to the state. So they had to, and so they were getting very much squeezed for profit. The other thing that was going on is the state would limit in California would limit rate increases to 7% per year. That was sort of a long-term max that they were not willing to breach. Well, these costs were simply were outpacing cost of this reinsurance was outpacing the amount that they could get in additional rate. And so in turn, companies were, because up against this hard where they couldn't get more rate, the state wouldn't approve more rate, and yet their reinsurance costs were going up. They had to take active measures to lower their reinsurance bill. And the way you have to, in California, your big natural peril risks are wildfire and earthquake. Um, the earthquake exposure is, in most of the market, is offloaded to a private public partnership called the California Earthquake Authority. So a lot of that exposure is already outside of insurance companies. But wildfire has been borne by the carriers. And these loss where was I going with this? Yeah, so
Yeah.
wildfire becomes your major catastrophic risk. And so the way you have to get your reinsurance costs down, if you're insurance companies, you've got to get rid of risk that are in these highly wildfire exposed areas. And so that's, ever since there was a series of very large wildfires in California. Like you said, what, the Camp Fire, Dalton, in 2018? Is that right? Yeah.
Yeah.
And then I was looking and then the other big ones in 20 and 21. I don't have the names of those, but these since they had these large wildfires, and we had a bit of a reprieve in 22, 23. Obviously, here in 24 and 25, things have come back with a vengeance with these big fires. These latest fires will probably be the largest fires, certainly in California, and perhaps the entire country in terms of damage. Um, but anyway, before this, companies had been non-renewing policies in the most exposed areas like the Palisades, areas like where the Eaton Fire is, areas where the old campfire was, areas around Lake Tahoe, and so forth, where and because they simply had to get their reinsurance costs down, so they wouldn't be losing money. Um, and so, now, as of these recent regulations, now that those reinsurance costs can be passed on, hopefully the market can start to be healthy again. But the state's gonna also have to allow more reasonable rate increases to cover these costs. And the other thing that happens in this market, unfortunately, is because companies have not been able to get the rates they need to cover their exposure in wildfire areas, they've had to raise rates across the board. So everybody, even in areas that aren't wildfire exposed, have been in California have been subject to much higher rates. So it's been creating some real challenges for this market, and we'll have to see where it goes from here. Um, should I talk about the FAIR plan for a minute, Dalton?
Yeah, I think that would be good.
Yeah. So what's been happening is in every state there are called insurance markets of last resorts, and they're state entities that are designed to step in and provide critical insurance when the market won't. And in California, that's called the FAIR plan. And in these wild, as these companies have said, have needed to flee the wildfire areas to preserve profitability or to even make money. Um, the a huge number of homes have been coming on to the FAIR plan, and I think as we looked, I think I saw a figure that something like over 70% of the homes in the Palisades were on the FAIR plan. The private market had abandoned that much of the market. And so that the FAIR plan runs like an insurance company. They buy reinsurance themselves, but they only have enough premium to afford to buy so much reinsurance. And as I said, reinsurance is expensive these days, and so it's highly likely, somewhat likely, that the FAIR plan through these most recent events they will lose, they will exhaust their reserves and they will exhaust their reinsurance, and we'll need to replenish. Now, the way they do have a mechanism that they can replenish, and the way what they'll do is they'll initially will ask all the companies in the market to contribute to pay off to pay claims, and then those insurance companies will in turn be allowed to raise their rates through special assessments in their policies. So again, all of California policyholders are going to have to step up and pay higher rates for years to restore the balance, if you will, on the FAIR plan. And that's going to create even more pain for the insurance customers of California.
No, I agree. Well said, by the way, with the reinsurance piece and illustrating to people that are listening that, okay, insurance companies needed to pull stuff out of their portfolio to reduce their reinsurance costs. And the best way to do that is to take risk that is in the highest, most fire prone areas, take that off the book. And hopefully someone else picks it up, like the FAIR plan. The FAIR plan has about $458 billion in risk and total exposure. So it's quite a bit. I don't know what the total market is for home insurance because I'm not in home insurance anymore, but I'm sure that's a substantial part of high risk areas. So it's 458 billion in high risk areas. And coupled with the fact that a lot of the homes in California are quite expensive in those areas, there might be a higher concentration, like the Easton and the Palisades. They're quite expensive homes, and they're all multi-million dollar homes. But that being said, very good point. Another good point that you made, Tom, was about the reinsurance. I have read that there's two things that I found that was pretty interesting. One, that a lot of times the reinsurance will have a clause for the wildfire where if it's within a certain amount of hours, they have like 156 and 256 hours, and within a certain amount of distance, they'll classify that as one event or two events, which is very important because if it's one event or two events, it changes what needs to get paid out. Do you want to potentially illustrate a little bit about that, the one event or two events? Like if you had a hurricane, that's normally classified as one event because it's a named storm, but with wildfires, you could have events going on throughout the state. How do you classify what's one event or two events? And if it's one event or two events, how does that change?
Yeah, let's use an example where a company buys a reinsurance cover. A small insurance company buys a relatively small insurance company buys a reinsurance cover that kicks in for losses above $20 million. And so once a loss exceeds $20 million, they'll access their reinsurance to pay losses up until they exhaust their reinsurance. Um, if an event is classified, or if there's another event, they have to pay another $20 million. A third event, they have to pay a third $20 million retention. So, I mean, I guess fortunately or unfortunately, the thing is, at least these two fires, the Palisades and the Eden fires, because they are within that time frame, those will be classified as one event, and the insurance companies will have to, will only bear a single retention, if you will. That being said, the reinsurance companies, will bear more of the loss, and will, it'll impact them more. Now, as people look at this event from a reinsurance standpoint, they're going to be fine. I mean, there's enough pools of capital. There's really little threat of insolvency among the broader reinsurance sector, but it just contributes to uh, these global trends we've been seeing, which I think at this point it's hard to deny. It's hard to deny climate change as being a driver of cost, but it's not the only driver of cost. But we are certainly seeing a higher frequency of high intensity hurricanes, and a higher frequency of high intensity hail events across the Midwest and in Colorado and elsewhere, and then wildfires as well. But it's not it's not the only thing that's going on. The other thing that's going on is general inflation. Inflation, post COVID, peaked around 9% overall, and in some sectors it was higher. So that's increased building costs, and those building costs have remained high. The other thing is what's called social inflation, and what that is there are litigation trends. There are trends in certain areas, particularly in hail areas, where roofers have been very, very aggressive in marketing their products, or marketing roof replacements, where they go into a neighbor and just go house to house to house and say, well, your neighbor's getting a new roof. Should we get you a new roof? And people might not even realize they have damage. In many cases, they probably have some roof damage, but it's not enough roof damage to where the roof is leaking or anything's visible on the inside. But yet, because there's been some loss of granules and loss of resistance in their composite shingle roof, they've been able to get a new roof. And so those sorts of trends, aggressive litigation trends, and sometimes fraud, aggressive roofing trends, overall inflation, have really been pushing the cost of property insurance upward, and really squeezing the market countrywide.
The roof thing with social inflation, that example, that's a huge issue in Florida until Florida eventually cracked down. But in general, the perspective of insurance carriers or MGAs, that there is especially in Florida, because that's where majority of my perspective is. Like before roofs, it was sinkhole, and then before sinkhole, it's something else, and so everyone sees this as the cash cow event, and so we're all in on sinkhole, and we're filing claims and escalating things, and we're filing lawsuits. And in Florida, they had a multiplier effect for attorneys. So if you won a case against an insurance company, even if it was $1, you would get 2.5 to 3 times what you would normally would have gotten. So there was an incentive to take insurance companies to court and hopefully win. And if you won $1, then you get your multiple. That over a long period of time, people and this whole industries are built over this thing that where you're just squeezing out billions of dollars from insurance companies. But the sad thing about it is the free roof that you're getting, or this free claim that's being expedited for you. One, the claim amounts are typically inflated. Two, you're the one that gets the free roof, but everyone else has to pay for your roof that you've gotten. And you multiply that by thousands of people, it adds up quickly. And I'm not to say that insurance companies never do anything bad, but for the most part in the world, there's a lot of good things going on. And especially insurance, how regulated it is, it's very difficult to do bad things. And if you're doing bad things, you're going to get caught. And there's a lot of clauses that if an insurance company goes insolvent, or if there's mismanagement, one, they should be pursued criminally. Two, other insurance companies will have to pick up the tab. Correct?
Yes, that's correct. And the way insurance is priced is you cover a large pool of risk. You expect a small percentage of those to have a loss, and so people for insurance will pay a fraction of their home value. Um, and the expectation is that um, you know that 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 the number you know the percentage of losses is much smaller than the percentage of people that are paying in. Typically one less than less certainly less than 1% of exposed risk gets subject to a complete loss, and then even the partial losses, such that you don't need to collect that much premium from everybody because you're able to spread it. Well, when you have litigation that's greatly increasing the number of claims and the cost of those claims, that becomes a problem. It unbalances the pricing models. When you have these cat events that simultaneously affect multiple properties, that can also unbalance the cost. The other thing I didn't mention about, when you see areas like large areas like the Pacific Palisades, I think there's over 5,000 homes there. When you see earthquakes comes ashore, we had Ian a few years ago was a major Cat 4 hurricane, came in south of Tampa. This last fall we had hurricanes Helene and Milton. Helene was a major flood event here in the west coast of Florida, and then as it got up in North Carolina and other areas, it caused more damage. But in those areas where you have a lot of damage, you get a phenomenon called demand surge. And what this is there's only contracts will flood. Contractors will flood in to do these repairs, but there's so much demand. There's so much demand to repair homes. In the Palisades, there'll be so much demand to rebuild homes once the permits start to get approved and so forth. And they promise to expedite those permits, that you run out of people that can do it. And so they can start to charge whatever the market will bear, and whatever to do things. And so it drives up that's another thing that drives up the cost above just standard inflation, that trend of demand surge. So
Yeah, good point about that. And one thing that we missed maybe was with surplus lines insurance, it is the free market. So and it's just different perspective for people listening, is that surplus lines is free market. So basically the state is kind of hands off. There is some things that you have to follow that the state says, like there's some laws and regulations that apply to surplus lines, most notably like how you go about cancellations and renewals and non-renewals. You can't just non-renew somebody whenever you want. You've got to give proper notice and allow them to find insurance cover somewhere else. But for the most part, you can change rates, you can include things in your rates when you want, but I couldn't change somebody's premium midterm 40%. That would have to be a conditional renewal. But that being said, the state isn't as hands-on as they are with admitted, as we were talking about earlier. And so what happens there is it is what the market will bear. So say that California is a very hard market, which means that the rates are high and it's difficult to get cover. You might have high deductibles or whatever is going on. It's whatever the market accepts at that time. So if everyone is offering, these independent groups are all offering X, and the agents are asking, hey, can you get to this price? I can win this when we market it to the insured, then that is what the market will allow. But if you go to a different state and it's a softening market or a soft market, the market determines what the price is. It doesn't necessarily mean that you have to play in that space if you don't like the price, but the market is what determines what it requires. And if you don't like it, then you don't have to offer any insurance in that area.
mm-hmm. Yeah, I mean, this is a market that has grown in recent years. This non-admitted market, it's not unregulated, but it's certainly lightly regulated. And
Mm-hmm.
generally, in the non-admitted markets, there's full freedom of premiums. There's full freedom of forms and coverages. And so, what companies can do is, they can tailor their coverage, to help mitigate their risk. And it's a market that can step in, to provide coverage, albeit oftentimes more expensive, but market that can step in to provide coverage, when the regular markets aren't there or pulling out. And so it is a solution somewhat. I mean, it's a solution, but it's not a large enough solution to be the entire market, and it's not and it does have some limitations. I mean, one of the key limitations of the admitted markets or the non-admitted markets is lack of access to a state guarantee fund. And so, insurance has been around a while, um, and and what used to happen, in the Wild West days, if you will, of insurance is companies would overexpose themselves, would go out of business, and would leave policyholders holding the bag. And so, people are out of luck. And so states, that's what triggered a lot of the regulation initially, a lot of the regulation we see in insurance today. But in addition to regulation, they also created what's called a state guarantee fund. And this is a fund that every insurance company pays into. It's a share of premiums. And that fund exists to provide support for policyholders when a company goes insolvent, when a company goes out of business. That's only accessible to the admitted market. So the non-admitted companies, they don't have that protection, and if the non-admitted company goes insolvent, there is no protection. Now, that being said, on the non-admitted side, and that's one of the things you do see high ratings, high financial ratings, generally rated by AM Best, um, in the non-admitted market. There's protections in place somewhat, and people are buying reinsurance typically to a level at or above a 250-year probable maximum loss event. We can talk more about that. This it's not as Wild West as perhaps it used to be, but again, there's not the full range of protections in the non-admitted market. But it's a market that has flexed, has flexed in California and has flexed in other areas to continue to allow coverage in these challenging conditions.
No, I agree. Do you want to just touch a little bit about your 250 statement, and then we could talk about what potentially do we need to solve, or not we, but
Yeah.
California needs to solve in that area to allow the market to open up and flourish?
Sure. Yeah. So we talked about these reinsurers and how they've had to increase their pricing because of losses. Well, all these reinsurances use these industry standard catastrophic risk models, or they have proprietary in-house models. Each of them do. And what these catastrophic risk models do, and the big names in that are Verisk, the Verisk Touchstone product. It used to be called AAR, and Moody's RMS model are the two largest players in the space. But there's Equicat and there's a few others. But these models run run thousands of years of simulations. Most of the standard is 10,000 years of simulations, and in that 10,000 simulations, they've come up with what they would expect for hurricanes over those 10,000 years, what they would expect for earthquakes over those 10,000 years, wildfires. There's wildfire models now, and there's convective storm models as well. So insurers and reinsurers will run these models against their portfolio of exposures, and that'll produce estimates of loss across those 10,000 simulation years. And from those, you get estimate of an average loss per year. You take all the losses, you divide by 10,000, but you also get to see, what are the largest simulation loss years. And so the 100-year probable maximum loss really is odds. That what the models is telling you in the 100 years is there's a 1% probability per year that the loss will be, this high, at this level or greater. The 250-year probable maximum loss is there's a 0.4% probability per year that the loss will be that much or greater. And so it allows insurers to sort of quantify, insureds to quantify their risk. Obviously, you can have the kind of major event, that we've really never seen before, that can exhaust. But the idea is that by buying to that 250-year level, which is quite common in the space, you've bought enough protection so that in most viable scenarios, companies aren't going to go insolvent. The other thing they're doing is when people buy reinsurance, they don't buy from one reinsurance companies. They typically buy from a panel of reinsurance companies, and that can be as little as 3 to as many as 10 or 12 and even 20 different reinsurers are taking parts of that risk. So that helps spread the risk around and helps reduce the risk of if one or more reinsurers were to go insolvent. So that's and that's what. But in turn, as we talked about, these people needing to get their prices down. Well, these cat models, the brush fire cat models that exist now, um, they're obviously going to suggest there's going to be more wildfire damage in mountainous regions and scrub regions than in the middle of the urban cores. And so that was driving their probable maximum loss, which in turn was driving how much reinsurance they needed to buy. And so those were the risks that needed to be shed. Right now, State Farm, for example, is getting a lot of heat because just in the last 6 months, they non-renewed a lot of the Pacific Palisades policies. They were trying to work with the state, trying to get the rates they needed when they were getting rebuffed by the state and weren't able to get the rates they needed to pay their reinsurance bill. They ultimately decided, hey, we have to start exiting the state, particularly in these high risk areas. Not just State Farm, but others did as well. And so they were in a bit of between a rock and a hard place. And I know they're facing bad press right now, but I can tell you, being a professional in this space, you get to the point where there's nothing you can do. I mean, you can't you can't as a private company, and all these are private companies. They can't lose money. They can't be losing money year after year because the cost have outstripped their ability to charge appropriate premiums.
It's good point about State Farm. State Farm, from what I read, requested a 30% rate increase for homeowners, personal line homeowners, and then a 50+ rate increase for renters. And as you mentioned, it's 7% is the max. So if you go over a certain amount, it's special approval. I think you have to have a video conference call and it's recorded and it's public, where you have to explain your reasoning and respond to exhibits with state legislature, right? From the DUI. That's how it worked in Florida previously when I had experience with it, with the exhibits I had to respond to when I worked in the pricing department.
Yeah, and the other thing that in California is interesting, there's legislation that actually funds these public watchdog groups. So there's these organizations, and the name of the most popular in California escapes me, but they can go to those rate hearings and they can protest the increase, they can challenge the increase, and they oftentimes are successful in preventing the amount of desired increase. I mean, it's not necessarily bad to have an adversarial party in these things. I mean, there's some good rationale behind it in terms of protecting the consumer, but unfortunately, the way things have trended over the years is that they've won more often than they've lost. They've also been able to hold on to that 7% cap for far too long, and as the cost rose, again, companies were stuck and had to find ways to get themselves back to profitability through reductions of exposure in the most vulnerable areas. So.
And I did see something recently on social media where people were complaining about State Farm, and they're like, okay, well, we have the State Farm Arena, we've got all this stuff, and why don't you just take this advertising budget and put it over into our California market and offer policies, and then you should be able to afford it. And then there was someone in the comment section that was like, okay, well, State Farm is mutual, so the policyholders are the owners, and then the advertisement is 2% to 4% of the revenue, and that revenue spend is to allow State Farm to broaden their policy distribution so they're less correlated with each other. So basically it improves your ownership of the State Farm shares that you have because you are a policyholder. But yeah, there's just a fundamental misunderstanding of why insurance companies are making these decisions. And it's easy to point fingers, but it's a multitude of things: mismanagement with the state, the watchdog groups, just the capital environment of reinsurance squeezing the insurance companies as they can or should, because it's costing them too much money. And so the insurer, or the insured, sorry, the insured is seeing one piece of the puzzle, but there's many moving parts that they're getting squeezed at the end. And when their price increased 40%, it's not necessarily that the insurance company is like, oh yeah, like Tom, I can get Tom here. He doesn't know where to go. I'm gonna give him another 40% raise. It's not how it works, but it's just in general, it's a complicated topic. And I don't think that there's a lot of discourse on the just different parties involved. I think a lot of times you see a perspective, oh, it's because it's a Democrat state and it's mismanaged, and also other stuff like look at LA. And then they're talking about, oh, well, insurance companies are super bad and they're evil and they just try to take your money and don't pay claims. And so there's these different segmented groups that have one maybe misunderstood part of the problem, but it does contribute to the core issues that the insurance market in California is necessarily falling apart. And this is a good transition to what could change. And I think one thing that they are opening up to is more advanced AI models to recognize and price risk. And so Zesty is currently the only wildfire vendor authorized in the admitted market, but Zesty is a good example because they are an advanced AI company. Although that their product is advanced, it is expensive for insurance to use, but it does allocate costs to the wildfire risk with frequency of a wildfire to happen and the severity of a wildfire occurring. That being said, they're the only ones available to use in the admitted market. And I think that California potentially is opening up their horizons and perspective of being able to allow other vendors with advanced models to enter the state and help spread the, I guess, additional information intelligence with related to wildfires, and provide a different perspective. Because one vendor doesn't have all the answers. One reinsurer doesn't have all the answers. I don't have all the answers. It's when you combine everyone's perspectives, you get a leveled set view. I think wildfire vendors and enabling the admitted market to price and use these advanced AI vendors, also being able to include wildfire costs within their pricing, which they couldn't do until recently with the reinsurance, but they also couldn't include certain wildfire factors. Being able to do that would be a big help in segmenting the pricing. In addition, I think that they just need to be a little bit more level-headed on where they're at in the current market, right? Like the market is very hard. It's very hard to get insurance in those areas. They need to take risk off their fair plan for it to be sustainable. And one thing that they could do is not require insurers to enter the state. If they enter the state and they want to include their reinsurance costs, there's a clause in there that they have to have a share within these high risk wildfire areas. So you're required, if you want to write business and include your reinsurance costs within California, you need to write in these high wildfire prone areas. But forcing people's hands on things that they may or may not do might be good. But I think if we're in the state that we're in California, it's better to work with the insurers and see like, hey, what do you really need for us to be able to write here? Like we need private companies writing in these wildfire prone areas. What would you need from us for you to feel comfortable writing here? And then let them tell you. And maybe what they say is so far away from what you want, and you meet somewhere in the middle. But I don't think that there's enough conjuncture between the two groups, because they had a third party advisory group that they paid for to let them know that it's essential to include reinsurance costs in their pricing, which I think is abysmal because it's pretty clear that you need to be able to do that.
Yeah, I think another thing that can bring the cost down over time, or at least control the cost increases, is more mitigation. There's an interesting case today with Florida. Florida after Hurricane Andrew. I think Andrew was 2005. It was a massively devastating hurricane to the state in the in the Miami, broader Miami area. And what you saw, whole neighborhoods that were just reduced to sticks. They just were not built to withstand large hurricane winds. I guess that was prior to 90. That was sometime in the early 90s, like 92. But anyway, so the first real set of hard Florida building codes came in 93, and they've continued to be strengthened. And what these impose for for the high risk parts of Florida, the beach areas, the ones that are most exposed to hurricanes, they have wind design parameters, and so a roof has to be able to meet 100, withstand 130-mile sustained winds in the highest things. That roof has to be held down by what's called hurricane straps. The shingles have to be attached with a certain number of nails. The windows need to have a certain amount of impact protection. So as a storm kicks up debris, the windows aren't penetrated. All these things that help make buildings more resistant to hurricanes. And had Florida not had those things, guarantee these recent storms would have been far worse than they actually were. We haven't, and Florida's been the leader in that sort of building buildings better to withstand natural perils. Other coastal states have lagged, but they've gotten religion in this over time. In the wildfire regions, maybe because it's relatively new, maybe because we're seeing really massive wildfires in recent years that we haven't seen in the past. Maybe because we've built more, and we continue to, as cities grow, they naturally grow into more of the wildland interface, they call it, where so they're more naturally exposed to existing trees, brush, and so forth. But there hasn't been robust practices in terms of either building codes or management codes to prevent losses. So there are some regulations in California around clearing nearby brush from a property. Those aren't enforced as well as they can be. But frankly, they also get a lot of pushback. I mean, people like trees. People like, and we've seen some stories in Public Palisades. People like their privacy. They like hedges. They like the trees, and they don't like to see this stuff, taken down or removed for fire protection. But we absolutely, you know, and then, there's already a long time ago there was the wood shake roofs, but there's more we can do. There's more we can do with roofs, and there's more we can do with the way we structure eaves and so forth to make buildings more fire resistant. And better job of clearing brush. And I think that's just going to have to happen over time. And the market, ultimately, you can't avoid these market impacts. You can't avoid the climate change effects and some of these other effects that are raising the risk of large wildfires and the cost of large wildfires. And so, over time, and hopefully it happens sooner rather than later, we start to have more mitigation, we start to have more resilient buildings, so that these costs don't continue to run away from us, and we can get back to more well-performing insurance markets where people are getting increases that are more in line with inflation, and not many multiples of inflation.
No, well said. One thing I think is a little different in Florida is Florida really only has to worry about their flood now. Hurricanes are still an issue, but with the regulations they put in place, the building codes, it's greatly reduced the issue. Really, when you see something devastating, it's like the floods that come in from the storm surge, or some random freak 1 in 10,000 rainstorm like you saw in Fort Lauderdale when it just flooded all of the airport and a lot of the surrounding areas and FAU campus. With California, they have the fire and then they have earthquakes, but they kind of counter each other because concrete doesn't do that well with earthquakes. Wood does better with earthquakes, but doesn't do so well in fires. There is things that you could do covering it up, but I think that's one of the core issues. That it might be a little harder problem for the building materials piece. I know that there is some stuff that you can do with like special types of concrete or special foundation things, but that's a complete rebuild for you to enable to have this earthquake proof and fireproof structure. In Florida, my Nana was able to be part of the wind hardening mitigation program. And so that was a program that allowed us to spend, say we spent 10,000, or if you spent 20,000 on the house for wind mitigation things, you could potentially qualify for $10,000 in credits. So if you replace the roof and you put in hurricane proof windows, that substantially hardens your roof, or not your roof, but your roof, because it's new, but your structure of your building. But if you did something similar where if you had a wood building and then you put down defensible space, it does harden your space where it doesn't allow as much wildfire in that area, but it still it's still a difficult problem to solve unless it's a complete rebuild. Right?
Yes. Yeah. No, it's a hard problem to solve. I mean, one of the things we talked about, these models, the Zesty model and some other models out there, but they're using imagery, and LiDAR radars and other things to like assess the vegetation, how close it is, how close is the house, assess the surrounding vegetation, the slope of the hills, and so forth. So they're providing individual scores on buildings as to how vulnerable they are to wildfire, and that in turn allows insurers to to price the most exposed properties the highest, as they should, and the less exposed properties less. But it also pushes the market into a low exposure mode. As as risks become very difficult to insure. But when you have the kind of regulation California had, where you couldn't use these models, where you couldn't pass along reinsurance costs, it was inhibiting those natural market forces that can promote better buildings, better fire management practices, and so forth. Simply to keep costs down, people will do those things, but there has to be financial incentives.
Yeah, if you close your eyes, it's not there, apparently. Sometimes, right? But the role of innovation. So we talked about a little bit of Zesty in AI, but what about some other things that need to be solved in just, I would say, mainly in the commercial space? I have seen some interesting wildfire vendors in the Intratech conference I went to that are, instead of having the perspective of partnering with the insurer, they're more partnering with the insured, where they're more of a partner with the homeowner. That's for personal lines. But what do you see on your perspective as something that needs to be solved in commercial lines? One thing would probably be like the manual processes could be automated.
Yeah, more manual processes can be automated, and with these AI these AI tools allow us to handle paperwork. There's still awful lot of paperwork that's coming in the insurance things, and so to the extent we can machine read that paperwork, interpret it, and then put in our data. We need fewer people. I mean, any way you slice it, there's a lot of people that are part of insurance companies, and that's great for jobs. But that raises the cost. That raises the cost on the end customers. So insurers are able to get more efficient using these tools, and they can and the market will dictate them that they will then pass on those. They'll have to pass on those savings, because then what's interesting about the insurance market, and what people don't often realize, is there are so many companies in nearly all lines of insurance that are providing the insurance. So we have a very robust competitive market, and so if there are cost advantages to be had, those will result in lower prices. With the other thing that's going on with called the Internet of Things, or internet enabled devices and sensors can be very helpful in this space. We've been talking today primarily about wildfires, but another huge loss category for the industry is water damage, from an overflow toilet, from a broken water pipe, cause huge amounts of damages to the interiors of homes, interiors of businesses. Well, more advanced modern structures and retrofitting, they're putting in water sensors. So if there's a constantly running situation, water's running constantly, the line gets shut off. There's already those things that exist. One of the challenges that there's been with earthquake is when an earthquake can sever gas lines, and when it severs gas lines, it can create fires. Well, more advanced homes are built with automatic shut off to gas lines. When the gas line breaks, it detects the leak, and the line is shut off. I think people, particularly after these recent fires, people are going to be exploring a number of things. It's some people were quite successful out there, out there with a garden hose, spraying around at the last moment, putting their lives in danger, but did protect some homes. Well, you could see sprinkler systems designed to to come on when needed to provide that protection in an automated way. So that's another potential area for improvement. All these things cost money, and some they don't pencil out. But as we're seeing here, replacing a home is very expensive. Insurance is very expensive, and so as these other costs rise, these mitigation measures can be becoming more cost effective. The other thing we're seeing it applies to wildfire, but also applies to wind, is more and more use of standing seam metal roofs. The facts of the matter is that composite roofs, the standard composite shingle roof, doesn't last that long. Doesn't last that long under high temperature conditions. Doesn't last that long under regular rain and hail. A metal roof, on the other hand, performs much better. Today, metal roofs are two to four times more than a composite shingle roof. But more and more businesses and more homeowners are making that choice, and they're making that choice, because they know it helps their insurance bill, and they know it ultimately is better for protecting their home. So it's and government sometimes it's individual decisions. Sometimes government regulations play a smart role. Certainly in Florida, as we talked about the building codes, the change we saw in Florida wouldn't have happened without robust government regulation on building codes. So there's places between private individuals, between industries and innovators. There's a lot of opportunity here to make ourselves better equipped to handle these higher natural perils, or higher frequency of natural perils.
No, I couldn't agree more, Tom. Is there anything that you want to share before we go to the end of the episode about yourself? Maybe if people want to connect with you on LinkedIn or something like that, if you're willing.
Yeah, sure. I don't know exactly what my LinkedIn, but name's Thomas Mercer. I currently work at Safe Lease, and working on a commercial property program for them. So that's where I developed a specialty, and is in bringing new commercial property programs to market. And I'm been at Safe Lease now a few months, and been some exciting work. So.
And how many times have you done that? So one time at my company, MSI.
Yep.
Another time, coming soon ish, whenever. I don't want to disclose what you've got going on privately, but with Safe Lease. And then there is you did that 2 other times again. So this is like your 4th time?
So it's that I got started in the catastrophic risk space with ICAT, an MGA in Boulder, Colorado. And while I was there, I put together a new residential earthquake program for us to cover homes in California for the peril of earthquake. After that, moved to Velocity Risk, which is another MGA that just recently announced their sale to Ryan Specialty Group, and was responsible for setting up. Was one of the founding members there, and setting up our data CAP modeling team and our data analytics team, and help pull together our small commercial program and get our initial large commercial programs going. And then more recently, as Dalton says, at MSI with a commercial property program, and now at Safe Lease. So it's been fun to be at the forefront of this, and seeing seeing ththese CAP models evolve and these internet tools evolve, and it keeps the job very interesting.
Yeah, Tom's a serial starter, so if you see a new insurance company pop up, it's probably because of Tom. But I really appreciate you on the show, Tom. Insightful as always. Wealth of knowledge for sure. If you guys listen or watch this podcast on YouTube, let me know what you think. Share your comments below and contribute. And as always, hope you listen in next week. And have a good day, good afternoon, good evening, wherever you are in this world. See ya.
Good.
Until next time.
Yeah. Thanks, Dalton. I enjoyed it.
Bye.